When world leaders emerge from a summit and declare victory, investors face a different question. What actually changed? Press conferences can generate headlines, but markets usually care about something more concrete. New contracts, policy shifts, investment flows, and long-term strategic commitments. The gap between political messaging and measurable economic outcomes is often wider than it first appears. That question became especially important after the latest high-profile meeting between the United States and China. The summit was presented as a major diplomatic event, with announcements spanning trade, technology, agriculture, aviation, and supply chains. Supporters described it as a breakthrough that could ease tensions between the world's two largest economies. Critics argued that many of the announcements sounded larger than they were. For future structures, the real story is not whether leaders claimed success. The real story is whether the agreements altered the underlying trajectory of U.S.-China economic relations after years of tariffs, export controls, and strategic competition. Did the summit create new economic opportunities that would not have existed otherwise? Did it reduce the structural tensions driving the trade and technology rivalry? Or were many of the announcements largely symbolic, offering short-term political wins without fundamentally changing the balance of economic power? Those are the questions that matter, and they are the questions this analysis will examine. To understand why this summit attracted so much global attention, it's important to look beyond the event itself. The meeting did not take place during a period of stable relations. Instead, it came after years of growing economic rivalry that steadily transformed the relationship between the United States and China. What began several years ago as a dispute over tariffs gradually expanded into something much broader. Trade policy became intertwined with technology, national security, industrial strategy, and supply chain resilience. Export controls on advanced semiconductors, restrictions on critical technologies, and efforts to reduce dependence on strategic imports reshaped how both governments approached economic policy. Businesses on both sides also adapted. Many multinational companies began diversifying manufacturing locations, while governments encouraged domestic investment in industries considered essential to future economic competitiveness. Rather than relying on highly concentrated global supply chains, policymakers increasingly emphasized resilience, redundancy, and strategic independence. Against that backdrop, expectations for the summit were unusually high. Investors hoped for signs that trade tensions might ease. Manufacturers wanted greater certainty for long-term planning. Technology companies were looking for clearer rules governing access to one of the world's largest consumer and industrial markets. Agricultural producers sought greater stability after years of uncertainty, while financial markets searched for evidence that the world's two largest economies could establish a more predictable economic relationship. However, rebuilding confidence after years of escalating restrictions is never simple. Even if both governments announce new areas of cooperation, businesses must determine whether those commitments translate into lasting policy changes or remain limited diplomatic gestures. That distinction is what makes this meeting so significant. The question was never simply whether both sides reached agreements. The real question was whether those agreements represented a genuine shift in economic policy, or merely another chapter in an increasingly complex era of strategic competition. Whenever major international summits conclude, official statements tend to emphasize achievements. Governments naturally present negotiations in the most favorable light, highlighting agreements, partnerships, and future initiatives. But economists, investors, and business leaders often evaluate those same meetings using a very different standard. Financial markets rarely react to optimistic language alone. Instead, they focus on measurable outcomes. Are tariffs being reduced? Have export restrictions actually changed? Are companies receiving new regulatory approvals? Will announced investments materialize? And over what timeline? These are the indicators that ultimately determine whether a summit produces lasting economic value. History offers countless examples of diplomatic meetings generating impressive headlines while delivering only modest economic results. Memorandums of understanding, joint working groups, and declarations of cooperation can create positive momentum, but they do not automatically translate into increased trade or stronger investment. Businesses typically wait for concrete implementation before making significant financial decisions. That is particularly true in the relationship between the United States and China. After years of shifting trade policies, companies have become cautious about treating political announcements as permanent changes. Executives planning billion-dollar investments need confidence that today's agreements will still be in place years from now. Without that certainty, many businesses continue pursuing diversification strategies rather than reversing course. Investors also watch market reactions closely. Stock prices, currency movements, commodity markets, and corporate guidance often reveal how professional investors interpret new information. If markets respond cautiously despite optimistic political messaging, it may suggest that expectations were not fully met or that significant uncertainties remain. This broader perspective is essential when evaluating the summit. The most important question is not how many agreements were announced during the meetings. It is whether those announcements produced meaningful changes in policy, business confidence, and long-term economic expectations. Only by examining those tangible indicators can we separate diplomatic messaging from genuine economic progress. One of the most strategically important topics surrounding the summit wasn't consumer products or traditional trade, it was rare earth minerals. Although they receive far less public attention than artificial intelligence or advanced semiconductors, these materials play a critical role in modern manufacturing. They are essential for electric vehicles, renewable energy technologies, consumer electronics, advanced defense systems, and countless high-tech industrial applications. Over the past decade, rare earth supply chains have become a growing source of geopolitical leverage. Because refining and processing capacity is heavily concentrated in China, manufacturers around the world depend on a supply network that is difficult to replace quickly. Building alternative production facilities requires years of investment, specialized expertise, and significant environmental permitting. As trade tensions intensified, export controls and licensing requirements became increasingly important tools in the broader economic competition between Washington and Beijing. Each new restriction prompted businesses to reassess supply risks, inventory strategies, and long-term sourcing decisions. For manufacturers operating global production networks, supply chain stability became almost as valuable as price. Against this backdrop, announcements regarding critical minerals attracted considerable attention during the summit. Any indication of smoother trade flows or reduced administrative barriers was welcomed by industries that rely on these materials. However, investors also recognize that easing short-term supply concerns is very different from restructuring the global supply chain itself. The broader strategic picture remains largely unchanged. Companies continue investing in alternative sources of critical minerals, while governments encourage domestic processing capacity and partnerships with resource-rich allies. These efforts reflect a long-term objective, reducing dependence on any single supplier without disrupting global manufacturing. In other words, the summit may have improved communication around an important supply chain issue, but it did not fundamentally alter the strategic competition surrounding critical minerals. For businesses and investors, the long-term challenge of building more resilient supply chains remains very much intact. Among the headline announcements from the summit, commercial aviation received significant attention. Large aircraft purchases have long been viewed as symbols of economic cooperation between the United States and China. Because commercial jets represent billions of dollars in contracts and support thousands of jobs throughout the aerospace supply chain, new orders often become one of the most visible outcomes of high-level diplomatic meetings. At first glance, announcing additional aircraft purchases appears to signal a successful round of negotiations. However, financial markets typically evaluate these deals with much greater scrutiny than political headlines suggest. Investors ask a different set of questions. How many aircraft were actually ordered? Were these entirely new commitments or revised versions of existing discussions? Over what time period will deliveries occur? And perhaps most importantly, how do the announced figures compare with what the market was already expecting? Those details matter because stock prices are driven by expectations rather than headlines. If investors had anticipated substantially larger orders, even a multi-billion-dollar agreement could be viewed as disappointing. Conversely, a smaller agreement can still be welcomed if it exceeds market forecasts. Commercial aviation is also influenced by factors far beyond diplomacy. Airline profitability, passenger demand, financing conditions, fleet replacement cycles, and aircraft production capacity all affect purchasing decisions. Government meetings may help create a favorable environment for negotiations, but they rarely determine airline demand on their own. For that reason, aircraft announcements should be viewed as one piece of a much larger economic picture. They may reflect improving dialogue between governments, but they do not necessarily indicate a fundamental shift in long-term trade relations. Investors ultimately judge these agreements by their commercial impact, not by the size of the announcement itself. Agriculture has consistently been one of the most sensitive areas in the economic relationship between the United States and China. Products such as soybeans, corn, beef, and poultry have historically represented billions of dollars in annual trade, making farmers and agricultural exporters particularly vulnerable whenever trade disputes escalate. During periods of higher tariffs and retaliatory measures, these long-established trade flows were disrupted. American producers faced reduced access to one of the world's largest food importing markets, while Chinese buyers expanded purchases from alternative suppliers to reduce dependence on any single source. As a result, global agricultural trade became increasingly diversified, with new suppliers gaining market share that had once belonged largely to U.S. exporters. Against that backdrop, announcements about renewed agricultural purchases naturally attracted attention. Greater market access and increased imports suggest an improvement in commercial relations, offering welcome news for producers that have endured years of uncertainty. However, economists tend to view these developments with caution. Restoring trade that previously existed is not the same as creating entirely new economic opportunities. If purchases simply return to levels seen before the trade dispute intensified, the practical outcome is one of normalization rather than significant expansion. Businesses also recognize that agricultural markets respond to more than politics alone. Weather conditions, commodity prices, transportation costs, currency movements, and global demand all influence purchasing decisions throughout the year. Diplomatic agreements can improve the environment for trade, but market fundamentals continue to determine how much is ultimately bought and sold. For investors, the key question is whether renewed agricultural cooperation signals a lasting improvement in bilateral trade or simply represents a temporary easing of tensions within a relationship that remains strategically competitive. If one industry best captures the strategic rivalry between the United States and China, it is semiconductors. These tiny chips power everything from smartphones and data centers to autonomous vehicles and advanced artificial intelligence. More importantly, they have become a cornerstone of economic competitiveness, making them one of the most contested technologies in the global economy. Over the past several years, semiconductor policy has shifted beyond traditional trade discussions. Governments now view advanced chips as strategic assets tied to national security, technological leadership, and long-term economic growth. As a result, export controls, licensing requirements, and restrictions on high-performance computing hardware have become central features of U.S.-China relations. For American technology companies, however, the situation is far more complicated. China remains one of the world's largest technology markets, representing significant demand for advanced computing products. Access to that market can generate billions of dollars in revenue, support research and development, and strengthen global competitiveness. Naturally, many companies continue seeking greater clarity and stability regarding future export policies. At the same time, China's response has been equally strategic. Rather than relying indefinitely on foreign suppliers, Beijing has accelerated investment in its domestic semiconductor ecosystem. Public funding, private capital, research initiatives, and manufacturing expansion all support a long-term objective of increasing technological self-sufficiency. While developing a world-class semiconductor industry requires years of sustained investment, the direction of travel has become increasingly clear. This creates a difficult balancing act for policymakers. Restricting technology exports may slow access to certain products, but it can also encourage domestic innovation and reduce long-term dependence on overseas suppliers. Conversely, expanding commercial access may benefit multinational companies while raising broader strategic concerns. That tension explains why semiconductor policy remains one of the most closely watched aspects of every U.S.-China negotiation. Even if diplomatic meetings produce incremental progress, neither side appears willing to compromise on what it considers a strategic technology advantage. As a result, the competition for leadership in advanced chips and the artificial intelligence systems they enable is likely to remain one of the defining economic stories of the coming decade. One of the most revealing aspects of the summit was not only what was discussed, but who was present. Alongside government officials, several leaders from major American corporations closely followed the negotiations, underscoring how deeply business interests are connected to the future of U.S.-China economic relations. For multinational companies, China represents far more than another export destination. It is one of the world's largest consumer markets, a major manufacturing hub, and an increasingly important source of innovation. Companies operating in industries such as technology, aerospace, consumer electronics, and industrial manufacturing have spent decades building supply chains, partnerships, and customer networks throughout the region. That explains why many executives consistently advocate for greater market stability. Businesses thrive in environments where regulations are predictable, trade policies remain consistent, and long-term investment decisions can be made with confidence. Frequent changes to tariffs, export rules, or licensing requirements introduce uncertainty that complicates planning and increases operational costs. Governments, however, often evaluate these issues through a different lens. While corporations prioritize market access and commercial opportunity, policymakers must also weigh national security, technological leadership, and geopolitical strategy. Those objectives do not always align, creating a difficult balancing act between economic growth and strategic competition. The summit highlighted this divide. Even if businesses favor broader commercial engagement, governments continue to place increasing emphasis on protecting critical technologies and strengthening domestic industries. As a result, executives may welcome incremental improvements in market access while recognizing that the broader policy environment remains uncertain. Ultimately, the presence of major corporate leaders served as a reminder that modern diplomacy extends well beyond politics. In today's global economy, business decisions, technological innovation, and government strategy have become deeply interconnected, and future negotiations will likely continue reflecting that reality. Once the diplomatic meetings concluded and the official statements were released, attention quickly shifted to a different audience: the financial markets. For investors, the summit was never simply about the number of agreements announced. The real focus was whether those announcements would lead to measurable changes in corporate earnings, international trade, and long-term economic growth. Markets tend to separate political optimism from economic reality. Investors look beyond press conferences to assess whether new policies are likely to improve business conditions. They examine company guidance, supply chain expectations, trade volumes, capital investment plans, and regulatory developments to determine whether optimism is supported by tangible evidence. Another important consideration is implementation. Announcing an agreement is only the first step. Businesses want to know when new policies will take effect, whether regulatory approvals will follow, and if both governments remain committed to carrying out the terms over the long run. Without clear implementation, even significant announcements may have only a limited impact on investment decisions. The summit also reinforced a broader lesson that has emerged over the past decade. Global companies are increasingly planning for resilience rather than assuming uninterrupted economic integration. Many firms continue diversifying manufacturing, expanding regional supply chains, and reducing dependence on any single market, not because cooperation has ended, but because uncertainty has become a permanent feature of the global business environment. For investors, that may have been the summit's most important takeaway. Diplomatic dialogue remains valuable, but long-term market confidence depends far more on consistent policy execution than on ambitious political messaging.